Welcome to Markets Now. I'm Michelle Rook along with Jim McCormick with agmarket.net. We had mostly higher prices on Friday in the ag commodities sector, except for nearby soybean oil, and nearby hogs. And Jim, we did see higher weekly closes in all of the grains. And considering we had such a bearish WASDE report, how much of a victory was that? And can we build on it?
I think you got to be very positive. I mean, the reality is, Michelle, you said it right. Those numbers on Wednesday were incredibly, bearish. That 2.2 billion corn carryout would argue corn should not be at 5. It should be closer to 4. 300 million bean carryout would be more than cumbersome. And even the wheat production went up. And like you said, the market ignored it. A good, strong technical close on on a Friday. Hopefully, I think we can build on it. It shows me that the market is still in a weather market mode. Beans are made or broke in August. Some of the longer range maps are hitting some dryness issues, and maybe the heat building back in for the Northwestern Corn Belt. And then on top of it, we do have the grain deal that expires early next week. And this may be the time after Putin continually crying wolf, saying he's going to cancel it and then end up not doing it. This time around, I think he may actually cancel it. And I think that added a little bit of strength to the market as well.
Yeah, and we can certainly talk about that a little more. But I do want to also ask you about whether the trade action also implied that the market believes that yield is going to go down here, and maybe in not just corn, but maybe beans and even like spring wheat.
Well, I don't know if you can say this. I think right now they're in a pause mode. I mean, I would guess we're going to see a little bit of a consolidation. The fact that they weren't able to build on bearish news on Wednesday, I would say, puts it into question if these yields are there. I mean, the government, like I said, left beans on loan, Michelle. I think they've only made a bean adjustment in July 6 times in the last 30 years. So leaving it alone should have been expected, I should say. But if you look at a lot of the traders that put out their yield model, kind of a yield program based on the crop ratings, those models are all arguing the bean yield is going to be closer to 50, maybe even sub 50. So I think the trade just is very skeptical that 52 yield is going to stick. And even the corn yield, they dropped at 4 bushels. The average trade guess was for a 5 bushel drop. And a lot of the yield models I'm seeing out there say you got another 3 or 4 bushel drop to go. And I think that would be more than likely to happen, simply because when you look at how bad the weather was in June, it's awful hard to argue, for me to believe actually, that this crop's going to be that much bigger than last year's yield, which is what the government said on Wednesday.
No doubt. And then you had the drought monitor still showing, 60, I think 3% of the corn acres are in some level of drought. So it seems like it's going to be hard to keep these yields going with that in mind.
Well, that's it. I mean, we have a big client base around the country, and most of them are saying the same thing. The weather has definitely made the crop look better. Where I'm at in northern Illinois, it looks really, really good compared to just 2-3 weeks ago. But the fact of the matter is a lot of this rain helped the crop rebound, but the subsoil moisture is still lacking across the vast majority of the Midwest. So if the models would start turning a little bit drier and then we start missing some rain, there's no doubt about it. Most of our clients fear that this crop will back up pretty quick, and the talk of the yields are dropping will come to the forefront. And that, I think, is part of the reason why we saw support here late in the week.
How much of it was also 15-week or 15-month lows in the dollar? And what does that mean here overall for the commodities sector?
Well, I think it's definitely had some of an impact. I mean, the reality is this, Michelle, the dollar going down, I think, is one of the signals that the market believes the Fed is very close to have not done raising interest rates right now. The Fed's goal, remember, was to raise interest rates to slow down the economy. When they do that, you are essentially telling investors, Michelle, get out of commodities. Do not fight the Fed, as the line goes. And you can look in the index funds specifically, the long-only funds. The moment the Fed started raising interest rates, they started liquidating that position down to some of the smallest net longs we've seen in multiple years. Well, now that the Fed looks like they're done raising interest rates, the interest rates are now higher than inflation, which is kind of where you wanted to get to, essentially kill off inflation. It does seem like that is starting to bring some spec money back into the commodities. The other thing I think you're looking at is overall the economy is just doing a lot better than people thought. I mean, for the last 6 months, a year, a lot of people feared that as the Fed was going to raise interest rates, it was going to cause the economy to go into recession. And if you look what the stock market's done, the stock market's actually trading higher now than where it was when the Fed started raising interest rates a little over a year ago. So you're maybe bringing a little bit of confidence back into maybe this market is going to essentially escape without a recession. And that, would be good for the economy. And that also could drive money back into the commodity market.
Yeah. So let's talk technically about the market, because December corn actually took out last week's highs, but we had soybeans kind of go up into some chart resistance that we ended well off of. And so, can beans take another run at it?
I think the beans definitely could take another run at it, Michelle. They could pull back. They're still above the 10-day moving average. They're above the long range, the long-term uptrend line. I think on a Friday, what you saw was corn and wheat were stronger, beans were down. We've seen that off and on all summer long, where you're seeing a lot of spread trades, I should say. Buy corn, buy wheat, sell beans, or vice versa. I think beans saw a little bit of a correction there, but the charts still look very friendly. And like I said, I don't think the trade completely believes that 300 million carry out right now. And I think they're hedging their bet going into the latter part of July and August, fearful that heat comes in. And if the heat comes in, that bean crop shrinks. And if you lose 1.5, 2 bushels off that crop, that 300 million carry out now goes sub 200 million. And the balance sheet that change in balance sheet will definitely change the psychology of the market.
Yeah. There was a lot of China rumors flying this week as well. Was the market maybe a little disappointed on beans today that we didn't get confirmation of that or not?
I would believe that's a little bit. I mean, we've heard rumors that China bought 10 to 15 cargoes of U.S. beans off the P&W, where, those are usually bought for the reserve. Our beans store a little bit better than Brazilian beans. But I think the market probably was a little bit disappointed with that. But more than likely, I think China is going to come in to buy beans because they can read the balance sheet. They can read the weather just like anybody else. And I'm sure they're a little bit concerned that if the weather would turn worse as we go into August and this bean crop shrink, the market could definitely rally up as it goes into rationing mode, which it would have to if you start talking a 2 or 3 bushel loss of production for some reason.
Yeah. Well, as I said, I wanted to go back on the Black Sea Grain Initiative and just ask you, if Russia does not extend it on Monday, what will the market reaction be as far as how much higher will we go? Because it just seems like even with or without the corridor, global demand has not been that great for our wheat anyways.
Well, I think in general, it might be a little bit positive, but I think it kind of depends on what happens actually if he does go out of it. I mean, there was talk earlier in the week, Turkey said, hey, if Russia would pull out of it, Turkey would send their ships as a way to, escort the ships out into the Black Sea. The problem you got, Michelle, that I see is it may not be the shipping problem. Do you have the crew or the nerve or essentially the insurance to bring a boat into Odessa? Remember, earlier this week, I think Turkey kind of honked off the Russians a little bit when Turkey essentially at one time was not going to allow the Swiss into the NATO. They changed their mind, and shortly after they did that, I believe, Odessa port was hit with some drone strikes. So it's something we need to watch. It's not just Putin deciding not to re-up the agreement. The question is, does he retaliate and maybe attack those ports? And if he starts attacking those ports, he could do some damage that could be very, very lasting. So it's something we need to watch. And I think, if that would happen, I think that would provide at least some support to both the corn and the bean market, the corn and the wheat market, and potentially the bean oil market as well.
Yeah, definitely been talk about him maybe sabotaging those port areas. Cattle market, let's move over there, Jim. So we have the bearish key reversal on Wednesday, totally negated it today with new contract highs. So how much of that is just what you said earlier, the economic situation looking better, or is it just that we're that supply tight?
Well, the balance is always going to be the supply versus demand. We've known for months now how tight the supply is based on the cattle on feed report, and it's only going to get tighter. The real question was the demand side of the equation. Was the consumer going to be willing to pay up for the beef right now? And it seems like, early in the week, like you said, we had an outside day down. The grain market was lower, and the cattle market did not respond positively to it. That really kind of gave some indications. Maybe we put a top in, but you saw how we closed the week. It was a very strong technical close. Right now the economy does look, like I said earlier, it looks like it's doing a lot better than people thought. And then also that weaker dollar, we're going to see that bring some demand back into the equation, not just domestically, but internationally. So, right now, overall, the trend's your friend at the moment for the cattle market.
Absolutely. And we did have cash bids starting to appreciate even Friday afternoon. And so that might have been a bit of the push as well. Okay, the hog market has been on a huge run here. A little consolidation today, maybe some unwinding of those spreads. But like I said, we've run this thing a lot farther than a lot of us thought. Are we close to a top, do you think?
I think it could pause, but I don't know if you're close to the top, Michelle. I mean, if the cattle market keeps running up, it's going to continue to support support the hogs. And then the other thing we just got to keep an eye on is demand. Like I said, with the dollar weakening so hard, lowest it's been in a year and a half, are you going to start seeing some international buyers come in and start covering their needs? I mean, the reality is, the prices, as a whole are still, they're high priced. But if you fear it's going to go higher, then you got to come in and buy it. So it's something we're going to keep an eye on. But right now, the trend is definitely up, at least near term.
Yeah. And cash and cutout values have been very strong here. And so as long as they're still going higher, that should continue to be supportive too, right?
You nailed it right there. I mean, cash is king, as they say.
All right. Thanks for joining us. Jim McCormick with agmarket.net. That is Markets Now.